Good morning, everybody. This is the live market open for Wednesday, November 30th, the end of November, the beginning of the last month of 2016. That's tomorrow. We have very busy markets. I'm Yohay, Elam, Forex Sequential Market Movers podcasting the show as usual for FX Street. We'll talk about recent developments in markets as always. There've been quite a few. We'll cover charts and levels, starting with majors and then moving to crosses. And we'll focus on the upcoming events. It's quite a busy week. The turn of the month, we'll preview the Italian referendum, also known as the referendum. Our currency of the week is dollar CAD. And of course, we'll preview the week ahead and wrap up the show. As always, your questions are more than welcome during the show. And if you cannot see the chat box for any reason alongside the screen, please go to tlk.io/fxstreet-forex-live-video. So what's going on in markets? Today is OPEC day. There are rumors all around, and that's grabbing the attention. So far, oil prices are moving nervously, but the swings are not that big. There are lots of rumors. Let's maybe talk a bit about that because that's the main event of the day. So we have regarding OPEC, basically back in September in Algiers, the various members of the OPEC countries decided that they will cut, but they made a general decision. They did not talk about who's going to do exactly what, but they talked about a range between 32.5 to 33.5. Now, the biggest contention is between Saudi Arabia, the largest producer, that in the past wanted to produce as much as possible, but now they're ready to cut, since September. And on the other side, we have two Shiite countries, Saudi Arabia Sunni. We have Iran and Iraq, which has currently a Shiite government. I don't know if it's only because of these sectarian issues, but maybe it's one of these things. Anyway, these countries don't want to cut, especially Iran, which just came online just recently and wants to reach the pre-sanctions levels. So these are the main points of contention. All the three countries are ready to give Libya, Venezuela, and maybe other countries exemptions from cutting. But in general, they want the whole cake to be shrunk a bit by about 1 million barrels per day. Russia and also other countries, especially Russia, which is a big non-OPEC producer, are also on the sidelines, are also considering some kind of freeze or cut to join in, but they're waiting on the sidelines, waiting for OPEC countries to move first. That means Saudi Arabia, Iran, and Iraq to reach some kind of a deal. I'm talking about this more in detail than usual because it doesn't only impact the Canadian dollar, on which we'll focus later on, but also it moves the dollar. Why? There's an inverse correlation. I know we haven't seen it in the past month because the dollar moved on Donald Trump, and oil prices moved on OPEC, but these correlations break up and then reunite. So there is an inverse correlation between the US dollar and oil prices. So if oil prices fall, if there's no deal, they can fall quite substantially. We could see the dollar rising as a result. Not the only reason for a dollar rally, but it could add to the dollar rally. And if we have a deal, and markets are currently a bit more hoping for a deal, it's more priced in than no deal, then we can have a weaker US dollar. And anyway, so that's the big event today. There are news headlines coming out throughout the day. I know there's now an official breakfast at 9 GMT and then an official meeting later on the day. But markets don't wait for the official events, like they didn't wait to see the official election result. When things become clear or when misinformation dominates the scene, markets are moving. Okay, so that has a major impact. Let's continue to other events and see, maybe we have questions. Good morning, Ed. Ed says, what a farce OPEC day. Laughing out loud. Who are they kidding? They agree whatever to get prices up, but then stab each other in the back and do their own thing. Besides, anyone trading crude should not get influenced by what they say and just trade the price action. Maybe that's sound advice. And price action is, of course, also a way to trade markets. And in this case, there's just too much news to follow. Regarding implementation, you're absolutely right. It's a point I didn't mention. In the past, OPEC members and also non-OPEC members have agreed, made bold statements, and then never followed them, never implemented. So they said they would cut, they had a quota of 30 million barrels per day. And eventually, it continued creeping up to 31. That's back 2, 3, 4 years ago. Okay, so you're absolutely right. But given the past, in the past 2 years, they failed to reach any kind of agreement. Remember the Doha disappointment back in April or 2 years ago, and Saudi said, we don't care, we want to crush the US shale industry and we're going to produce as much as possible. So just reaching an agreement will also impact prices, even if everybody knows that implementation is totally different thing. But if they don't even reach an agreement, then it's of course negative for oil prices. Okay, so that's a good point. Let's continue with other things we're seeing lately. We're seeing more significant dollar corrections. Okay, so since the early November, hope for fiscal stimulus by the United States, by the new administration of Donald Trump, tax cuts plus infrastructure spending, plus military spending, without cutting Medicare or Medicaid, making America great again, making all promises come true, push the dollar higher, and expectations for higher interest rates. And of course, Forex is never ever a one-way street, and we've seen corrections. But in the past few days, where we've seen more significant dollar corrections, that may be related to end-of-month flows. Portfolio managers need to consolidate, and things, well, after such a huge rally, maybe a bigger correction is needed, not only a dead cat bounce. All right, but maybe we'll see this US dollar rally resume after the month ends. That means later today, actually, even before the new month begins. And of course, depending on data, maybe markets will find excuses. For instance, if we have a good non-farm payrolls or just as expected non-farm payrolls, that will serve as an excuse to continue buying US dollars. But so far this week, we're seeing more significant dollar corrections, getting used to new ranges. Political news, there's still uncertainty about the Trump transition. Lots of names are being thrown out for Treasury Secretary. It'll probably be Steve Mnuchin, but you never know. There's so many new rumors also of that. That's in the background, currently not impacting currencies, but something we should be aware of. The Fed rate hike in December, that's exactly 2 weeks from now, and December 14th is all but confirmed. We would need a total disaster in the non-farm payrolls or another huge market event to change the picture, but we got very, very big hints from Yellen. Data has also been quite good. We'll talk about that soon. On the other hand, on the other side of the Atlantic, we had Mario Draghi keeping the cards close to the chest, but at least what we know from inflation figures, the picture is not so good for Europe. There are higher chances, in my opinion, for an extension of QE. More money printing, more pressure on the euro than phasing it out, tapering it by reducing bond buys. But we'll talk about that, of course, more in detail next week. And today, let's begin talking about the data. So I mentioned the good US data. We had GDP published yesterday. We covered that live on FX Street with Valeria Bednarik. Yesterday, it came out above expectations at 3.2%. Expectations were for 3%. That's, of course, good news. It's becoming a bit stale. It's Q3, but still of importance. Durable goods orders came out better than expected. They beat expectations with 1%. And also on the core and also other figures, other slices and dices of this measure came out above expectations. Here's new home sales were okay. A big beat came in consumer confidence yesterday from the conference board. It beat with 107 points. Okay, here in Europe, we had a miss on German inflation with 0.7 year over year. It's not really advancing despite the base effect of oil prices. Of course, if we don't get a deal today, we could see it pushing global inflation down later along the line. But we're seeing the inflation beginning to rise in some places, but in Europe, at least core inflation is not moving so fast. We'll get these figures later today. The IFO figure from Germany, business confidence is quite stable and quite high at 110.4. UK GDP, defying Brexit, was confirmed at 0.5 quarter over quarter, 2.3 over year. The pound has not suffered like the euro and the yen, when looking against the US dollar. And Japanese inflation remains low, 0.3. All in all, if we look at the biggest economies, we have the ECB, dovish due to low inflation, the Bank of Japan remaining dovish due to low inflation, and the Bank of England somewhat, closer to the Fed, let's say, not so dovish. They are neutral. What do we have today on the agenda? Of course, OPEC rumors all day long. Maybe even during the show, we'll get some wild action over there. Just after the show, we have the German unemployment change. The labor market in Germany looks really good, and we're expecting another drop in unemployment. More importantly, for the Eurozone, for the euro, is Eurozone inflation. Preliminary numbers for November, expecting another tick up in headline inflation to 0.6, but core inflation is stuck at 0.8. Mario Draghi talks again. Actually, it's the second time this week, and also last week he spoke quite a few times. This time he's in Madrid, in Spain. I'm also here in Spain, in Barcelona, and but I don't think he can tell us anything new, and I don't think he wants to. I think he wants to keep his cards close to the chest. Then we will have market-moving events for sure. The ADP non-farm payroll is a big hint towards the NFP. Not always well correlated, but always moves markets. And 15 minutes later, Canada's GDP. Maybe it'll be a bit overshadowed by OPEC. I mean, if you trade the Canadian dollar. And at the same time, we have the Fed's favorite inflation measure. That's called the core PCE price index. Will probably remain at 1.7 year over year. And even if it does move today, at this point, it's sort of markets are fixated with the rate hike, and that's probably will not change. I mean, I don't see how it can change the picture. What else? It's quite a busy day. Again, OPEC will run all day. We have the Chicago PMI from the United States at 2:45 GMT. US pending home sales should not move markets. Oil inventories could add to the mix for OPEC. If they rise again, maybe it'll urge them to cut. If we have too much oil running around, maybe they will cut production. And we have a speech from Jens Weidmann, the head of the German central bank, the Bundesbank, that maybe could have an impact on the euro. So quite a busy day to end November. Okay. And now we'll cover the upcoming events for the rest of this week. So Thursday, December 1st, begins early with Australian capital expenditure. For those trading the Aussie, this is an important event. It's released only once per quarter, and it has a big impact on the decisions of the RBA. That means it has an impact on the Australian dollar. Later, we have the Chinese official manufacturing PMI from the government, but later comes the more important release, the Chinese Caixin manufacturing PMI, the independent measure of the state of the manufacturing sector in China. It's important not only for the Australian dollar, but for the global economy. It's PMI day, and we have it also in the United Kingdom tomorrow morning. And then, as always on Thursday, the US jobless claims. Yet another hint towards the NFP, but not as important as the ADP. The ISM manufacturing PMI, that's already more important hint. Look for the employment component and look to see if this sector is bullish, is optimistic on some kind of a Trump plan. Remember, there's a difference between what politicians say and what they do, but currently markets are optimistic. On Friday, of course, it's NFP day, but before that we have retail sales in Australia, construction PMI in the UK. At the same time of the NFP, the Canadian jobs report, so it's also a very busy week for Canada. That's why I picked it as the focus of the currency of the week later on. And regarding the non-farm payrolls, basically we're expecting no big surprises, expecting a gain of 165,000 jobs. That will be in line with what we've seen last month, around the same levels. Healthy gain in jobs, not as strong as maybe last year, but the US economy is getting closer to full employment, and it's natural to see these job gains slow. The positive thing when we're getting closer to full employment and it's harder to find employers, wages begin rising. Finally, we've seen a break above previous levels last month, 2.8 year over year, a level not seen, I think, quite a few years, can't remember exactly how many, and we had a big jump of 0.4 month over month. This time expectations are a bit more modest for 0.2. I believe that even if we have it, even 50,000 jobs gained and wages even fall by 0.1%, I mean, a terrible report by all means, we will still get the rate hike. It'll be a blow for the dollar in the short term, but nothing extraordinary regarding, will not move Yellen and the Fed. We can expect, but I don't think it'll be terrible. I don't think it'll be really great. I think it'll be good enough, continuing the trend. In recent months, we didn't have too many big surprises. We only had them every once in a while. Always trade with care the non-farm payrolls, even though a rate hike is priced in, even though traders are looking at OPEC, looking at what Trump will do, looking at the ECB decision next week, the non-farm payrolls is always a big event. Okay. Questions? I don't see at the moment. Okay, let's continue to our next segment. And finally, after all this talk, we will move to the charts. So we'll begin by looking at major pairs. And this is our technical segment for major pairs as we enter the month of December, the last month of 2016. Very busy year coming to an end. So we'll start from the top. Euro dollar currently 106.42 in the higher end of the recent range. This is the daily chart. We can of course see the big fall, the rise over there, almost to 113 on election night in the US, and then the big fall. We should note here the double bottom at 105.20. This is a level that if we zoom out here, we can see that we reached this level back in December last year. Okay, so it's a very important level. That's when the ECB announced another set of measures. Markets had already priced it in, and the euro rebounded. Anyway, this is sort of the line in the sand, but there's even another line further below. That's 104.60. That's the 13-year low for euro dollar recorded in March 2015. But looking a bit to the upside, 105.70 was the initial low, a pivotal line in the range. 106.60, and we're getting close to this level. And above that, I still left here the 107.10, which was a swing low earlier this year. If we move to even higher ground, it's 108.20, but that's a bit far off. There is lots of talk of euro-dollar parity. Will it happen in December? We would need a very dovish Draghi and a very hawkish Federal Reserve. I don't think we'll get this kind of toxic mix. Maybe it'll come later on. I don't rule out parity anymore, but I'm hesitant to jump on this train. Maybe around the inauguration of Trump, but probably I don't see it coming this year, but who knows. Pound dollar, much more stable, of course. 124.80. Lots of good things also happening in the UK economy, not only doom and gloom. 124.80 is the current level. 125.30, next line of resistance, immediate resistance, followed by 126.90 over there. 126.70. Further above, we have the initial post-Brexit low of 127.90. Okay, seen in late June. Looking down, 123, a round number, and also served as support twice. Further below, 121.70, which is a weak line, much stronger support at 121, and the round number of 120 was never really worked as support. We had the flash crash in early October, but of course it's a very round number. Dollar yen has reached a peak here at 113.80. Now that's not only a peak recently, but also a peak seen back in the spring. So that's a very strong line of resistance. Also, we can mark it as a double top on dollar yen. The next line is also, well, double bottom several times, as you can see here. It served as a line in the sand for the Bank of Japan, and then worked to support once again. 116, also huge line. So big lines to the top side. To the downside, it's a bit more complicated. We have 111.40. Well, that's still also a strong line. Worked here as support, and now as resistance, and then as support. Further below, just under the 110 level, we have 109.80. Another strong line is 107.50. Dollar yen, as Valery Bednarik mentioned several times, has a tendency to trade in narrow ranges for frustrating periods of time, but when it does pick a direction, it doesn't really stop. Now we're seeing a more significant correction after this very long Trump rally. Let's see if it continues. And let's continue to commodity currencies. Dollar CAD in high tension, expecting the OPEC decision and other events. Currently 134.36. Weak resistance there at 134.70. Choppy to the top side 135.40 and 136. Even higher, we have 136.40. To the downside 133.80, which is already a more substantial line, a bit less choppy, and 132.65. Much lower, under all this choppy range, we have 130. I believe we'll see an end to this choppiness once we get some kind of clarity, or once we get some kind of decision today or non-decision from OPEC, some clarity regarding the move. Aussie dollar 74.85 at the moment. Made a nice rebound, so 73.10 line worth watching as support. Further above, used to be strong in the past, 73.75. 74.40 served as support, and now it's somewhat weaker support. The round number of 75, always relevant, very round number, is now resistance. Next level, 75.80, 76.50, which was a swing high in the past. 77 round number, and I would say 77.80. Okay, above that we have 78.40, but that's a bit far off. I see lots of pressure on the Aussie. If we look even below 73.10, we have 72.50 and 71.75. Aussie dollar has been relatively choppy, relatively range bound, not as good as it used to be. Kiwi dollar, here we have more directional trading, more excitement. Currently 71.67, 71.80 is the line to watch, followed by 72.65, 73.60, 74.15, and high above 75. To the downside, currently 71.40 is weak support, 71 a round number, another round number is 70, but it's followed really closely by 69.70. Much lower, we have 68.80 and 68.40. Okay, we'll complete our major pair roundup with dollar Swiss. Watch out for interventions by the Swiss National Bank. So far, it has been more of a proxy to US dollar strength, and we have seen less intervention from the SNB. Anyway, 101.90, 102 is high resistance. 101.70 is just below. Looking down, we have 100.60. The round number of parity is not only a very round number, but also worked here as a swing high. Further below, we have 99, 98.50, and 98.20, sort of a choppy area. And further below, 96.60 and 95.50 as levels to watch on this pair. So this completes a roundup of major currency pairs. And now let's talk about technical lines for crosses for the month of December 2016. So Euro Swiss, prone to intervention by the SNB, currently just under 108. We've seen some of these lines that were thought of as lines in the sand by the SNB. We've seen a breach. Anyway, I would expect the pair to move back, thanks to the SNB, thanks to other forces, back to the 108, 110 range. I would mention Key lines here are 106.85, which has been the recent low, 107.60, which was a previous line in the sand for the S&P. Then we have lots of choppy lines here between 108 and 110. I don't think it's worth mentioning. 110 is a strong line of resistance, and then 110.50 and 111.20. I would trade this pair with extreme care. This is already a more interesting cross. Euro pound, we've seen it shoot high, then fall back below, sort of head and shoulders pattern. Currently at 85.20, support at the round number of 85. I see I have too many lines here. 83.35 is a strong line of support, worked as such back in September, and further below 82.67. But ranges are a bit higher. I think the trend is still, well, the trend is mixed. Let's not get into fast conclusions. 86 is a line to watch. 87 worked as resistance in the past and could do that once again. 88.80, the low end of the high range at the round number of 90, worth watching, of course, but stronger resistance at 90.50 and 91.50. Euro yen, a popular cross, but not for retail traders. Just under 120, which is a line of resistance, followed by 121, or another round number at 121.60, 122.30, and 123, lines that were last seen in the summer. Looking down, we have 118.50 and 117, and very strong support at 116.25. Look how it served as a double top. Even lower, 114.50, 113.80, and strong support at 112, and another strong line is 111. Pound yen. This is already a cross that is popular among retail traders. Getting closer, we've seen the stability of the pound against the weakness of the yen. Above 140 at the moment, 141.80 was the recent high. Should be watched. It's followed by 143, sort of swing high. Looking down, we have 139. 139, followed by 138.50, 137.50. But these lines are already a bit more choppy. I would mention the bigger lines here are 132.50, 129, and 125. So in the past few days, this cross has been trading in a narrow range, but these things don't last too long. Okay, and to complete this segment, we'll move from across to the world's #1 commodity, oil, WTI, crude oil, West Texas Intermediate. When people are talking about oil, notice if they're talking about WTI or Brent or other oil prices, it's a bit geographical. Anyway, currently just under 46. Remarkably stable, I would say, given the amount of rumors. I see markets as cautiously optimistic about a deal, and prices are still relatively high, assuming a deal. So I see more potential to the downside if there's no deal. Lines to watch here are 46.50, 49, which was the high in August, and we have the double top just under $52 US. Looking down, 44.50, weak support, 42.50 or 42, let's update this line, is already much stronger support, last seen, earlier this month, and the low seen in August is 39. Some talk about even lower levels if oil prices, if we zoom out. Remember that early in the year, we already reached 26.50. Okay, even lower, 26. So I don't think we'll reach these levels, but a big fall, more than a dip under 40 is realistic. 39 is an important line there. Let's add another line here, just in case the deal fails spectacularly. It's 35.20, which was a level last seen in the spring. Okay, so that's a roundup for prices and, of course, the price of oil, which is ever relevant today. And let's continue. Now I'll preview the Italian referendum, also known as Renzi-rendum. You can follow this hashtag, Renzi. This is Italian Prime Minister Matteo Renzi. He is young. He's about 40, 41 years old. He came into power as a reformer from the left, managing to unite a few parties in parliament, make some reforms, but not others. Now he wants to do an even bigger reform, okay? And he put his political career on the line on this referendum. He wants to change the constitution, take some powers away from some institutions, give them to others, make the country a bit more governable. This is seen by many as the next big domino. After Brexit, after Trump, as Matteo Renzi is seen as mainstream. If he fails due to populist anger and resigns, Italy, the Eurozone's third largest country, will also be in trouble ahead of elections in France with Marine Le Pen and other events. I think the event is a bit overhyped, but this doesn't mean it cannot move markets. Okay, so let's do a bit of background here. So the Italian referendum about constitutional change was declared after he failed to reach the 2/3 majority to make the constitutional changes. He does have a majority in parliament. His government is relatively stable, okay? But the constitutional changes are about making it easier to govern, okay? About cutting red tape. Italy is a very bureaucratic country. More or less, Italy had one government per year since went back to democracy after World War II. So Italy is sort of famous or infamous for unstable governments. But this specific government, led by Renzi, is remarkably stable. I've heard and read articles about this referendum. There are critics and there are supporters, some good and some bad components, changing the powers of municipalities, things that shouldn't interest us too much, but basically making the country more governable. I don't really have an opinion about if it's a good change or a bad change. Matteo Renzi's Partito Democratico, his central-left party, mostly supports it, but former Prime Minister, the infamous Silvio Berlusconi, is against it. The left five-star movement, radical left, is against it as well. So there's lots of opposition. Renzi, as being young and coming relatively from the outside, and he's trying to put himself as anti-establishment as well, because that's what works today, being anti-establishment. And he's staked his political future on the vote. That means he said he will resign, but resigning doesn't mean he's out, and resigning does not mean immediate elections. Another government can be formed within the existing parliament, okay? So if you see it, I mean, a no vote is the end and the big mess for Italy. I don't see it that way. Current opinion polls indeed show no in the lead, okay? They show that Italians will reject the reforms led by Renzi, but polls have been wrong. Usually they've been wrong against they went in favor of the anti-establishment movement. We're not sure who's the anti-establishment here. Anyway, no vote will result in, of course, uncertainty. What will be the next government? Which powers will the next government have to enact reforms? And it will cast doubt on the next elections in Europe, most importantly, elections in France, but also in the Netherlands earlier in the year and Germany later on. But again, it'll probably be some kind of a technocratic government. And again, Renzi is not necessarily the establishment. The five-star movement, led here by Beppe Grillo, the person on the left, former comedian, is lurking in the background, but it is doesn't have a majority. Just ready to take over. And also, Silvio Berlusconi, which is of course a prominent figure in Italian politics, he's already 80 years old and he has some business issues. So I don't see extreme changes coming very soon. So what does it mean for euro dollar after all this political talk in the third largest economy? Failure is mostly priced in, okay, because of the opinion polls, which have been quite consistent and showing a no vote. A further fall depends on the political reaction. Renzi might not necessarily quit. He might say, okay, I got 48% of the vote. That's good enough. The people like me. I'll continue. Remember that David Cameron pledged not to stay in power even if Brexit goes through, and a few hours later he quit, and he even quit parliament afterwards. Anyway, so politicians don't always fulfill their promises. The key for Eurodollar is a stable government that is pro-European, and I think we will get that in any case, either by Renzi or one of his fellow politicians in his party or someone else. And what happens if yes wins? L'Italia che dice sì, I hope I'm pronouncing it correctly. That will mean a rally for the euro. That'll be an unexpected and positive result. Think about like Brexit. If we had no vote leading in the polls, and then it would end in yes, I mean it would end in Remain. Anyway, euro is likely to rally. There will be talk about an end to populism, as Italy holding up the wall after Brexit, after Trump, and giving hope also for a more mainstream result in France, Germany, and other countries. So I don't think it'll happen. I don't think the polls are that wrong. I think it's around 10% lead for no, but you never know with opinion polls. You never know what people vote for. Again, I think a no vote is mostly priced in. So if yes wins, there is much more upside risk in for the euro, because that is the real surprise, not a rejection. Okay, it's not like the U.S. elections or Brexit when we had the mainstream ideas candidates in the lead. This time it's the other way around. Okay, so that's a preview for the Italian referendum. And our currency of the week is dollar CAD, the North American pair. We're going to focus on three factors that move the currency. It's oil prices, clearly, especially when we're recording the show today on November 30th, but that's the immediate mover. Canadian domestic figures and the dollar Trump rally, the US dollar, not the Canadian one. So let's start with Canadian crude oil prices. So if you're watching the show today, not the recorded segment, there's a 50-50% reach a deal. If you're seeing it afterwards, you know the result. WTI hugs the 45 level, which is more or less in the middle of the range of 39.52. The Canadian dollar seems relatively vulnerable. What does it, when I say vulnerable, what does it mean? It's the Canadian dollar is rising just a bit when oil prices rise, and it falls much more when oil prices fall. That means it's showing weakness. And markets are looking for reasons to sell the Canadian dollar and doing it a favor by buying it when oil prices are rising. I believe this will continue for quite some time. Okay, that's something to watch out for. And another thing here to mention is we need a break of this range to see a big impact on the pair. Okay, we would need a total failure of OPEC today, a big breakup. Good morning, Ramon. To see in Canadian dollar really collapse, or we would need a great deal today and to see it, or rising oil prices in general to see it, the Canadian dollar advancing. Again, the currency is more vulnerable to the downside if oil prices fall, but it's the immediate mover of the Canadian dollar. But in the longer term, I think oil will have less of an impact. In addition, if oil prices remain lower for longer, it's important to remember that Canadian oil is expensive. Okay, Canada extracts its oil from tar sands in Alberta and the north of Canada. It's more expensive than Middle Eastern oil. It's more expensive than oil coming from Texas. Probably as expensive as oil coming from the Dakotas. Probably, well, anyway, if the world moves to more renewable energy and oil prices remain low, we'll still continue using oil, but this kind of oil will probably not be prominently the type of oil that Canada extracts, the more expensive oil to extract from tar sands. Canada needs high oil prices. So that's regarding oil. So oil is the immediate mover, but not for the longer term. Domestic data. This is Prime Minister Justin Trudeau. The recent jobs report was great. There's another one coming up just this Friday. Canada is trying to move away from oil to other things. Prime Minister is already 1 year in power, and he introduced some kind of fiscal stimulus, not on a very, very large scale, but previous governments saved money when oil prices were high, and these are good times. I mean, this is a good opportunity to spend this money. GDP, because of oil, has been a bit bumpy, and there are worries about real estate in Vancouver, where the British Columbia government announced some curbs on real estate, and also in Toronto. So watch out for that. We didn't have a bust there yet. Retail sales are a bit weak, and this is also something to watch out for. I believe that domestic data in Canada will have a bigger role on dollar CAD. And the third factor is the Trump rally. So to remind everybody, US dollar rallied because markets expect Trump and with full control of government, of Republican Congress, to add fiscal stimulus, cut taxes, and spend a lot on basically everything, infrastructure, Medicaid, wars, whatever. That means stronger dollar, higher inflation, higher interest rates. In theory, if this really pans out, it's also good for Canada. That means it'll be good for the Canadian dollar because Canada, apart from oil, depends on a lot of demand from the United States. They're big countries, big neighbors, very long border. So it should be good for Canada. We will really know what's going on with Trump. Not now, probably only after the inauguration on January 20th, and maybe we should give Trump, as we should give any president, the 100 days of grace. So I believe that by the end of April, we will know what Trump really did and what he didn't do. I believe markets are getting a bit ahead of themselves, believing him literally. Specifically, Trump says many contradictory things, and we should take any politician with a big grain of salt. But the more stimulus in the US, the better it is for Canada. So I believe that we'll see the big impact late in January and in February, March, and April to see how much the Canadian dollar moves because of US politics. Okay. My bias is for the downside for Canada. That means upside for dollar CAD. It's not a one-way street. Why do I have this bias? First of all, oil prices, I believe, will continue being pressured to the downside. And as I said, Canadian oil is expensive to extract. And I think that Trump will not fulfill his promises. Will have less demand for Canadian goods coming from the United States. So I think there's more pressure to the downside than to the upside, despite the Canadian government's efforts to stimulate the economy. Doesn't mean Canada is a bad place to be. It's still one of the best places in the world. Just the Canadian dollar, I think, has less room to the upside. Let's now look at the, and as we speak, of course, we were seeing oil prices jump up today. So just take a quick look at that. Maybe there's been a rumor about a deal. Looks like that. So again, a deal is good for the Canadian dollar. Not fully priced in. And let's see if we already have an impact on the Canadian dollar. Yes, we do. Again, if you look at the charts, you see bigger move in crude in comparison to the reaction in the Canadian dollar. Again, the Canadian dollar showing weakness, rising, but not so much when oil prices rise and falling much more. But for this segment, let's look at the bigger picture for the Canadian dollar. Again, lines to watch here are 133.80, 132.65, 130. If we look even lower, if we have a huge oil rally and a consequent rally in dollar CAD, 128.30 is another line to the downside. To the upside, we have 135.40, 136, 136.40, and even much higher, of course, 140. If we have a total collapse of the loonie, 143.25, and that was early in the year when oil prices were really rock bottom levels. The dollar CAD almost reached 147. Okay, as we speak, I see that things are looking better for oil and for the Canadian. Okay, so that completes our segment on dollar CAD. Morning, Amon. Good morning, Ed, once again. Again, no worries. You can always see the rerun, and you can also see the individual segments. Let's preview next week's events. Next week, the first full week of December. Monday, we'll have a reaction to the Italian referendum. We talked about that earlier. Again, if there's a yes vote, it's good for the euro, and this is totally not priced in and not expected. Mainstream expectations are for a no vote. We have services PMIs on Monday in the UK. It's the most important sector there. Should have an impact. It stands on its own this time. It's not on a super Thursday with the court decision and the Bank of England's decision like it was last time. The ISM non-manufacturing PMI in the US, usually a hint for the NFP, but this time it's released afterwards. Still important. It's also in the US. It's the biggest sector. On Tuesday, you have rate decision in Australia. No changes expected there, but I believe that the new governor, Philip Lowe, will try to talk down the currency. We have the for those trading the Kiwi, we have the milk auction also on Tuesday. And Wednesday, busy day. We have Australian GDP. There's only one release in Australia, and the first and final one. We have rate decision in Canada. A lot depends on what happens with oil prices and what happens with the Canadian jobs report, which is due on this Friday. And let's see, the tone of Stephen Pelosi and the Bank of Canada has been relatively dovish. Let's see if this continues. Oil inventories, as always, this time without the shadow of OPEC. Final GDP in Japan, there are usually, this usually sees the revisions, so could impact the yen. ECB decision, that's the main dish next week. The big question is here, we'll talk about it also next week more in detail, but the big question is, will the ECB extend its QE program as is in March when the program is expected to end, or will it taper it down, cut it back down, reduce it from 80, let's say, to 70, and make a plan to end it at some point? My tendency is for an extension for a few reasons. First of all, inflation is still weak in the Eurozone. Eurozone economies still need more support. And secondly, thanks to this Trump rally, we had a sell-off in global bonds. The sell-off in global bonds means that more bonds are eligible for buying for the ECB. More bonds now have higher yields. The ECB has a minimum of minus 40 basis points. It's negative deposit rate. Many German bonds had yields below this level, making them ineligible for the ECB. And now the ECB has less scarcity, more room for buying more bonds. We'll talk about that more in detail. We'll have inflation figures. We'll have everything, more data to talk about. And then Friday, we have UK trade balance becoming more important as it's becoming more acute for the UK economy, and consumer sentiment in the US. The preliminary release for December by the University of Michigan coming very early. So that should be also a market mover, especially as it relates to the month of November, Black Friday, things like that. Okay, so the ECB is the main decision. Also the Italian referendum. Mario and Matteo are the stars, but also watch out for rate decisions in Australia and Canada, and quite a few other events. All right. So let's wrap up the show. The wrap up for November 30th, the end of a very turbulent month, a month that saw the US dollar rising quite a lot. OPEC Deal or no deal, according to price action on the charts, as Ed mentioned, we're probably getting closer to a deal, but the rumors will swirl all day long. Something to watch out for. What happens today, and this will have implications for the US dollar, as there's an inverse correlation between oil prices and the US dollar. We've seen bigger dollar corrections this week. I don't think it can stay for too long. Some of these corrections are due to end of month flows. Let's see what happens with US data. The Fed rate hike will not be impacted by US data, but the positive US data has not, we haven't seen a reaction to that, so you could still see it. Good data is the GDP beat, the durable goods orders, consumer confidence, and we have now coming up a build-up for the non-farm payrolls. The big events for today, Eurozone inflation will shape the ECB decision. Draghi will talk once again, also relevant. Build-up to the NFP comes with ADP non-farm payrolls, and tomorrow with the ISM manufacturing PMI and jobless claims. Non-farm payrolls expectations are for more of the same, nothing earth-shattering. A gain of 165 jobs, a monthly rise of 0.2 in wages, sort of back to normality after a great month last time. Let's take a quick look at the charts in this wrap-up. Zoom in on the price action in the during this morning. So we're seeing US dollar weakening, maybe a result of higher oil prices as well. Euro dollar in range. Watch out for 106.60 this morning, 107.10 to the downside, 105.17, 105.20. Pound dollar also here. The pound is gaining against the retreating US dollar. Remember, end of month flows, 125.50 there, 150, 125.40 level to watch in the immediate term, 123.80 to the downside. The dollar yen seeing this range of 111.40 to 113.80 in the bigger scheme of things, currently at 112.80 in the middle of the range. Dollar CAD watching OPEC as close as ever today. 133.80 to 134.80 is the immediate range, but when we get real news from there, not only the rumors, we might see a break to either direction. 50-50 chance for an OPEC decision, an OPEC cut, but it also depends on the nature of the deal, of course. Australian dollar 74.80, support 74.40, resistance 75, very stable in range, and the Kiwi dollar 71.60, looking good this morning. 71.80, 72.65, and 71 are levels to look out for. And we talked so much about oil, so in the past half hour or so, we're seeing oil prices rise, probably on optimism, 3.7% higher on the day. I believe we will see bigger moves, even bigger moves later on with oil. Okay, that's been quite a busy show. Talked about many things. You can watch all the video clips separately or the full show on FX Street and later on also on Forex Crunch. Thank you very much for coming and for the questions. Wish everybody a safe and successful trading day. That's it for today. So see you in our next live coverage. I believe that will be the ECB next week, and before that on the morning show next week, same time, Wednesday at 8 GMT. That's 8 in London, 9 here in Barcelona in Central Europe time. Okay, so that's it. Thank you, and till next time. Ciao. Bye-bye.